And on here right now, this is Nick Ohlson with the Ohlson Group. We're going to get started in just 1 minute or so. Thanks. Consultant at the Ohlson Group. I want to thank everybody for taking their time out today to tune into this webinar. I know everybody's time is valuable. Everybody's busy out there, so what we try to do is give you good real-time info to take home with you to make some money and sales with your clients today, and to take things with you that you can truly integrate into your current practice here. So once again, thank you. All right, well, today we're talking about the secrets of income planning. And I guess maybe to kind of start off looking at this marketplace, it's best to really talk about the financial fears of retirees. And what we're looking at here are many different things. Number one, market volatility. I guess you could say that might be an understatement here, with people not sure where the stock market is going these days. When are we going to hit 1,300 with the S&P again? Are we ever going to do that? How long is it going to take? When I retire, I'm not sure where the market will be and where my money will be. So a lot of sleepless nights are spent thinking about this market volatility, especially with a lot of senior market retirees. Speaking of retirement, job loss and forced retirement is another big one that a lot of people, maybe in their mid-50s, 60 years old, are being told that, hey, now you are retiring, here's an early payoff, but because of this downturn in the economy, we're having to let some of these older employees go, and a lot of these clients are having to figure out how to make their money last when they're retiring a lot earlier than they thought they were going to. Also, there's a lack of confidence in all financial markets, not just the stock market. I don't know how many bank closures there have been. There have been over 200 in the last couple of years here since the financial downturn. So people are wondering, if I have my money in a bank, even though FDIC has raised the protection rate up to $250,000 per account, is it going to take a while for me to get that money out? Is it going to be swallowed up by a different bank? Is there going to be problems with me getting cash out when I need it? So banks are a big one. Insurance companies are as well. There have been some downgrades, most famously AIG, looking at them almost going bankrupt. And I know we sell the American General side, which is a different area than just a corporate AIG, but that brought a lot of attention to our marketplace too. And I'm sure you got a lot of clients that are very concerned about financial ratings of the insurance companies. So, and a lot of people, all these things together, they're concerned about running out of money. First of all, a lot of these early retirees they don't have to be early retirees, but they're worried about living too long and probably having to live on a smaller income than they want to, because they're afraid that money may not last them their whole, lifespan. I mean, you see every one of these different type of investment commercials now talking about following the green line to retirement, or making your money last as long as you do. Everybody's getting in this income planning game, and it is a big concern on clients' minds. Well, with all these things together, that's kind of the doom and gloom part, but I think this is our greatest opportunity. The reason being is because we can, with our products, we can guarantee principal, we can guarantee growth, we can guarantee a withdrawal rate, and all those things put together, we can guarantee an income for life for our clients. And with these guaranteed lifetime withdrawal benefits are really the hottest thing I think we have going in our marketplace right now, and that's what I intend to show you in this webinar today. All right, well, let's look at kind of the agenda on what I want to cover here today. And this is going to be, I'm going to try to make it 45 minutes so I know you East Coast people can get to lunch and get back to some of your appointments for the day too. So first of all, we're going to talk about secrets from top producers here. So I don't want to just sit up here and just make up a bunch of concepts that I think may be successful with you in your practice. What I want to do is share with you what our top producers are using to be successful, and of course some of the things that other people are using that aren't successful too, so you have to step in those same potholes twice. Then we're going to go over some of the hottest new products that have come out in the market right now that are really inventive and can fit a niche when you're dealing with these new prospects of yours. And then we're going to talk about case studies here, how these products and these secrets from top producers all kind of work into everyday cases that are ones that, you know, I and other people here in our staff have worked on here. All right, well, one of the things I want to talk about here to kind of frame up the way that some of our top producers are having success is how you approach these clients in these different turbulent economic times. My father, Ray Ohlson, the head of our group here, he does these different 10-minute tip videos, and one of his newest ones was talking about economy, which basically is saying, you know, what does, you know, the general economy, yeah, it's all doom and gloom out there. We're talking about unemployment hovering around 10%. We're talking about a stock market that's in the toilet. You've got a bunch of different problems here, but what does it actually mean to your clients? You know, they're, like I said, they're hearing all this terrible economic news, unemployment, stock market down, low interest rates down, so you can't even put something in a fixed product right now, whether it be a CD or a fixed annuity, and really make much money. You know, we got this big budget deficit because of government bailouts and the wars and all these things that are going on. It can really just kind of make a client put their head in the sand and not do anything. But what a lot of our successful producers are saying, okay, you know, Mr. Client, I know you're concerned with all of these things, but what does this really mean to you? Okay, unemployment's high, but you tell me you're retired, right? Okay. You know, the stock market's turbulent. You know, the products that I'm talking about, sometimes they share maybe in the upside of the stock market, but can suffer no downside risk, so we're not worried about the stock market. Yeah, maybe interest rates are low across the board here, but, you know, with my income guarantee products, I can guarantee you for the income part, which is what you're concerned about, I can guarantee you a 6, 7, 8, 10% growth on your income account. So we don't have to play by those low interest rate rules. And all these other things, yeah, we're going to be backed up by the Guarantee Association. We're going to diversify your products among a lot of different top-rated insurance companies here. So, you know, you can't just sit there and put your head in the sand, Mr. Client, because the economy's bad. What does it really mean to you? You don't have to participate in this bad economy and all these other things here. You can you know, operate in an area where these things don't affect you. Another thing that a lot of our top guys are doing, I say guys, top guys and girls, of course, is talk about income insurance. You know, a lot of times over the last 10 years, we've had, I know, a lot of people that sell index annuities, and a lot of them that have securities license, some of them that don't, you know, have talked about, you know, really almost making this as an investment alternative. Well, I guess it is because it's a lump sum of money that's growing at a certain rate, but, you know, they get really caught up in talking about crediting strategies, caps, spreads, you know, historical returns, how maybe it could have beat, you know, mutual funds over the last 5 or 10 years. Well, that's all great and everything, but I think really what we need to turn now to make this product be different is to really sell the insurance component of this, not as a pseudo investment. You know, why don't you compare our type of product that we sell here to homeowners, auto, mortgage insurance, fire, flood, that type of thing? You know, your clients insure all of those other things that are very important to them. Why aren't you insuring your retirement? Why aren't you buying something that's going to protect your income stream for retirement in case of a market downturn, or in case you know, interest rates fluctuate, or in case we have inflation? You know, why would you roll the dice with one of the most important things that you should be insuring here? So sell those components of our insurance products that our other competitors can't sell because they don't have them. Another way to say it is that we are in the risk management business, where we can help to manage any risks out there by giving you a baseline income that you can't outlive, that will be your essential income, that will always be there no matter what happens in the outside economy. Another way to look at it too here, to really kind of maybe once again get these clients who are just kind of frozen like deer in headlights, and they're looking at, you know, different parts of the economy, different things going wrong here and there, compared to other options. I mean, the client needs to do something if they're in retirement, right? So let's look at non-insurance options. Okay, you're talking with a guy from Edward Jones. I don't want to pick on Edward Jones for any reason, but you know, they're a big financial brokerage. You know, if you look at any financial planning guru out there, anybody from Jonathan Clements from the Wall Street Journal to other places, they'll say, hey, if you're 65 years old and you have the optimum mix of stocks and bonds, equities and bonds, then you can take out a 4% potentially safe withdrawal out of that brokerage account for life. And you know what? You're only going to have maybe a 10 to 15% chance of running out of money. Well, I don't like to hear that. You know, you have they usually state it as you maybe have an 85% chance of not outliving your money. Well, I like to look at it the other way and say, okay, maybe we do have a 15% chance of running out of money. I don't want to take that chance. I want to eliminate that. And, you know, a lot of times they say, well, that's only if you take out money in a market downturn. Well, geez, isn't that what happened to a lot of people over the last couple of years that retired and took out money out of their accounts while it took a 40% drop? Well, okay, that's one option, Mr. Client, that you can do. But I think if you agree that you have a lower risk tolerance now that you're in the retirement phase, you know, I think I can show you a better option. Other options out there, CDs and money market accounts. I mean, shoot, those some of the CDs are paying less than 2% on a 5-year CD. Money market accounts, I mean, they're making peanuts right now. And with inflation in there, I mean, you're basically losing money in those type of accounts. So those aren't really viable options on the Safe Money platform either. So, and these things aren't guaranteed. You know, those rates can fluctuate here, and it's not really, a path to retirement that you can do to ensure this income. So I think when we look at different options out there, what I'm going to present here makes a lot of sense for the majority of your clients that are in retirement mode. This new solution here that I think should be an essential part of a lot of retirees is this guaranteed lifetime withdrawal benefit. I know a lot of you people already sell it out there. Some of you are new, but basically we guarantee an accumulation percentage for this income account. Then that's coupled with a withdrawal percentage based upon whenever the client starts taking income, whatever that's grown to. You have a percentage withdrawal rate on that. And those things together put this guaranteed income that you can take for life. Even if the account value goes all the way down to zero, you can always still take that amount of money. So with that, I'm going to go into some of these different products. And, we here at the Ohlson Group are licensed with about 30 different carriers on the annuity, life, and long-term care alternative side of things. And I'm just going to go over a couple of the key ones here now that have some, interesting parts to them that I think are unique in the market, and then I'm going to show in the case studies how a lot of these products can be applied. First one is with Aviva, A-rated carrier we've worked with for a long time here, and they've had one of the leading income planning products here with this rider, the Income Edge Plus rider. They have the new Income Preferred series that are the base products that this rider can be added to. This rider grows at a 7.2% compounded growth rate that can go up to 20 years. So the 7.2, that wasn't just some random number they picked out. They used the rule of 72 there, where at 7.2 compound interest, your account will double in 10 years. And if you let it go for 20 years, it will quadruple in 20 years. So it's pretty competitive, I think, telling a client that, maybe they're 50 years old, at age 70, $100,000 will be $400,000 for income purposes. These base contracts, you can do a no bonus product, but you can also give a 5 or an 8% premium bonus that's added day one to the client's income account as well. Now, nothing's free here. They have a 75 basis point fee that's deducted from the account value every year from this. And they have a ratcheted withdrawal rate system. For those of you familiar with these type of products, you know that when the client starts income, the older they started, the higher the guaranteed withdrawal rate they have for life. So, for example, I believe with Aviva at age 65, you're looking at a 5% withdrawal rate. At age 75, for example, you're looking at 6%. Another suite of products that's really been competitive here since they really busted onto the scene a few years ago for the income side of things is Forethought Insurance Company here. They're an A- rated carrier with AM Best based out of Indianapolis, where our company is headquartered. And their big product, which is great for loss recovery, and we'll go through that later, is the Income 125. Now, this product has a 25% income account bonus day one. Now, this isn't a cash premium bonus that's added to your client's income account. It's like a front-loaded roll-up that $100,000 turns into $125,000 of income account day one. Then you also get a 5% compounded interest rate on top of that until you start taking withdrawals. And then this one's really simple. At whatever age you start taking income withdrawals, you get a 5% withdrawal rate off of whatever that income account has grown to. Now, the nice thing about this product, there is no fee. It's just built into the contract. So there's nothing that's going to be deducted from your client's account every year. They currently have a 7% commission on this product. It will issue through age 85. And like I said before, it's great for loss recovery. If a client needs to get some money back towards their income account, this is a great way to do it. Another product with Forethought is their newer Index Bonus 115. Now, this one still has a nice big 15% income account bonus that works like the 125 does, but they have a higher 6% growth on the income account, a 6% roll-up. So at sometimes, at later years, the 115 will eclipse the 125 as having a higher income account value. But this is also a better product for Forethought for the older ages because it has a higher withdrawal rate if you start the income at an older age. So you can go up to 7% at higher ages on the withdrawal, whereas with the 125, you're always going to be at 5%. So it really depends on the age of the client, too. You want to look at both products for each situation. They do have a charge for this. Like Aviva, they have a 75 basis point rider charge. And one of the things, too, that they have is a very interesting death benefit rider. For another 75 basis points, that the client's death benefit will grow at 5% per year. So it gives a guaranteed death benefit situation. We're going to show an example on how these death benefit riders work later on as well. Right now, they have an 8% commission on this. It'll issue through age 85, and it does reduce from ages 76 to 85. Now, the last product series I want to go into before we get into case studies here is this new Phoenix Secure Lifestyle Bonus product. Now, this is a specific proprietary product series that's only out there for members of the Ohlson group, which we and 6 other IMOs became a part of a couple months ago. And basically what we're doing is taking different product ideas that we want to see to different insurance carriers and having them write it on their paper. And this first one that we came out with is through Phoenix Life. This product is a 10-year surrender product with a 10% upfront cash bonus. Now, that 10% bonus is issued all the way through age 85, no reduction on that bonus. Some states, including Indiana where we're at, it's a 8% bonus with a slightly lower surrender charge, but that 8% bonus as well is still issued all the way through age 85. They have some inventive crediting strategies on this product, but today I want to focus on income, and so I want to focus on this gift benefit rider. Now, this rider is very different than others because it combines income and death benefit into one rider. Now, with the income account, it grows at a 10% simple interest per year. And with this, there is no limit on the length of time for the roll-up. So you can roll up, 35 years if you want to before you take income off of this product. They don't cap you at 10, 15, 20 years. So it's great for younger people that want to put money into a product like this. But not only do they have the 10% simple interest, but they add in these persistency bonuses between years 6 and 12 of the contract. Now, they have a great income worksheet that I can send you all if you're interested in this that shows all the details. But basically, 55% extra is added to the client's account between the years 6 and 12. Now, with all of those things put together, that income account will triple in 12 years. So I think, for a 10, 12-year deferral type of period, I don't know of anything else that beats this product out there as far as being able to say that that income account will triple in 12 years. And they have the withdrawal rates that increase as the client gets older. Again, for example, at age 65, you're looking at a 5% withdrawal. At age 75, you're looking at a 6% withdrawal. So it's competitive in that area as well. Now, the other component, like I said, it has a death benefit provision as well of this gift rider. It guarantees a 6% compounded growth on the death benefit until it gets to 200% of the premium plus the bonus. So if you put 100 grand in, day one with that 10% bonus, you're at 110. This will grow on the death benefit till you get to 220,000, for example, or age 85, whichever comes first. So I'm going to show an interesting example later on, too, that you can take withdrawals out of this product while your death benefit account is growing in order to preserve some of the principal for the next generation. Now, this is one rider that both things are included. You get one or the other. If you kick on the income, your death benefit provision just becomes your account value. That 6% is out the window. Of course, if the client passes away before they start the income, then you just get that death benefit provision. But you don't have to choose right now. It's one rider, 95 basis point charge for the whole thing. This has a great 7% commission rate. It's reduced at age 76, but it goes all the way through age 85 as far as being issued. Now, one thing right now to get in with this product while they're doing this fresh rollout is they have these producer bonuses for 2010 business. And you can get an extra 1.5% on business for what you do now through the end of the year. And the bonuses start just at $50,000 of premium. For example, you get an extra half-point bonus if you just do 50 grand. You get 75 basis point bonus at 125,000. 1 point at 250,000, 1.25 at 500 grand, and 1.5% extra on $1 million of premium. And this is all retroactive bonus for all the business you do in 2010 and is paid after the first of the year. So if you have some clients on this, this is a great way to have some an extra bonus that can help pay for maybe some of those presents after the holidays there. And like I said before, this product line is issued exclusively through the Altusure Group, not through a regular Phoenix Life contract if you have it. All right. Well, enough on product here. Now I want to get into some of these different case studies. Like I said before, I'm sharing with you real case studies that we've done with our agents here and things that have worked and the clients have bought these products based upon these recommendations. What I'm going to talk about first is just generally how we like to structure these income plans when you're meeting with the clients. Then we're going to talk about situations where there's a future income need. Then we're also going to talk about when there is a now income need, when the client is retired and they need to start taking money immediately. We're also going to talk about how we can recover losses for income, and also talk about income with principal preservation, talking about not eroding that principal but still being able to drive an income off of that asset. But first of all, I want to talk about structuring this income plan. Now, we have great fact finders on ohlsongroup.com under the members only section. If you're appointed with us, you can get the password. But you know, what we want to do when we go through this fact finding is first we want to solve for the essential income, the absolute baseline required income that this client needs no matter what. They need that coming in to pay for housing, bills, food, all their other obligations that they can't do without. Then we'll figure out what the other part is that's still important, but it's more of the discretionary income. That's for vacations, entertainment. I see a guy riding a Harley here. Maybe some people think that's essential, some people don't, but I don't know, to buy toys like that later on. Other type of things that you'd like to have money for, but you know what? We can maybe roll the dice with that and not have some of those discretionary things if we don't need it. And then one of the big things, we want to adjust for inflation for future years, especially with some of these younger retirees, where that could erode some of their purchasing power. Well, let's first talk about using guaranteed lifetime withdrawal benefits for a future income need. So we're going to, quite simply, find that required or essential income that's needed. We're going to find the number of months or years until that income's needed. And then we're going to kind of back solve for that premium needed, utilizing a guaranteed roll-up and a guaranteed withdrawal. So let's look at an example of how this works. Let's say we've got a 60-year-old male with a $500,000 IRA. He's planning on retiring in 5 years. And based upon Social Security, pensions, other income sources they have, they need off of this $500,000 an extra $30,000 per year. So what we can do is show this client with our income insurance program how much premium is needed now to fund that in 5 years. So what we did with this client is we put them into the income preferred bonus, which gives an 8% cash bonus, and the Income Edge Plus rider that we covered earlier. And by using their simple software, we found out that roughly $392,000 with that 8% bonus and then a 7.2% compounded growth rate from that rider for 5 years equals a little over $600,000 after 5 years. And this client at age 65, they qualify for a 5% withdrawal rate. So 5% on $600,000 gives you $30,000 of income per year guaranteed for life. Even if the client lives to be 100 years old and that account value goes all the way down to zero, they can still keep pulling that $30,000 per year off of that. Well, and you can see here I didn't use all the $500,000, so we can use that other $107,000 for discretionary income. Maybe to put that, if the client wants to roll the dice in the stock market, or if they like to do some of their personal investing, maybe they want to buy some life insurance, we leave that open for other things here. But this agent could go back to this client and say, hey, I can tell you right now, you give me $392,000, I'm going to be able to get you $30,000 for life with a 100% chance of not outliving your money. So that was a great way. This agent closed the sale, the client was happy, and they put them on that path to retirement. The next thing we're going to talk about is a income now situation here. I'm sure many of you are familiar with the laddering concept, where traditionally we've used SPIAs, deferred annuities, and even index annuities, but utilizing annuitization off of these. Annuitizing one of those products every 5 years, maybe for a 5-year payout, And then once that's gone, you annuitize the next pot of money for another 5-year payout to kind of have a steady income stream, over a period of time. Well, that's kind of the concept that a lot of our agents are using, but with this 3-bucket system, they're integrating it with a guaranteed lifetime withdrawal benefit on the end as the 3rd bucket or the 3rd leg. So what we use first is a period certain SPIA that we put the money into to get the first payment of money. Then we'll use a multi-year rate guarantee annuity to grow during that SPIA payout. And then we kick that on for an annuitization after that first SPIA runs out. Then after that SPIA runs out, or if that annuitization runs out, then we kick on the index annuity with the guaranteed lifetime withdrawal benefit to guarantee income for the rest of the client's life. And we like to adjust for inflation on this as well, especially if it's a longer-term situation where we want to make sure that that doesn't erode their purchasing power. And we'll show you some different examples of how this works here. First, step 1 with the immediate annuity, quite simply, we decide how much annual income your client needs right now. Then we'll purchase a period certain SPIA for that desired income. Step 2, we purchase a multi-year rate guarantee annuity to replace that income when step 1 SPIA runs out, just like I was saying before. And we match that multi-year rate guarantee annuity guarantee period to the SPIA period certain length. So that surrender charge period and that guarantee charge period is over after that SPIA runs out. Then, like I said, we buy an annuity with a guaranteed lifetime withdrawal benefit to start income after both of those annuitizations and SPIAs end. So let's look at an example. Here we have a 58-year-old female with $700,000. She needs $2,500 a month starting right now, starting in 1 month. And she wants payments to adjust for inflation. She's a younger retiree here. She wants to make sure that her purchasing power is not eroded. So what we did first, bucket 1, we bought a 6-year certain SPIA from Equitrust Life that at the time, $173,910, gave them $2,500 a month guaranteed for 6 years certain. So we solved that need for 6 years by taking $173,000 out of that $700,000 and buying the SPIA. Step 2, bucket 2, we bought the Sagicor Sage Investor Annuity. Now we've matched that period certain SPIA payment with the multi-year rate guarantee payment. With this product pays 3% guaranteed for 6 years. So $151,000 roughly equaled almost $181,000 after 6 years. And based on today's SPIA rates, which, interest rates are fairly low right now, so I think it's a pretty prudent way to use today's SPIA rates in determining future income, because chances are hopefully they'll even be higher for the client. But even based on today's rates, that $181,000 roughly will pay out $2,600 a month for 6 years certain. So now with these 2 buckets, we've covered 12 years of income pretty much guaranteed for the client. And we've adjusted for inflation, moving her income from $2,500 to $2,600 for the second 6 years. Well, for bucket 3, what we could do, going all the way back, we're buying all these products right now. We're putting in roughly $216,000, and we use this Phoenix Secure Lifestyle Bonus annuity, with the gift rider that we talked about. We put that into the product, which luckily we have exactly 12 years of deferral because of the 6-year SPIA, and then the 6-year payout from the multi-year rate guarantee annuity. We give it 12 years for that income account to triple. So that 216 becomes roughly 654 after 12 years. And then the client is 70 years old, where they qualify for a 5.5% withdrawal rate, which equals $36,000 per year, or $3,000 monthly. So we've compensated for inflation by moving her from $2,500 to $2,600, and now we're making sure that she's taking care of inflation for the future by giving her a guaranteed $3,000 a month for the rest of her life here when we kick on this third bucket with the guaranteed lifetime withdrawal benefit. And with utilizing that money, she had $700,000 total. So now we still have $158,000 left over for liquidity to buy other things or just keep in the bank there in case she needs funds for other things. Now I will be I neglected to mention I'll be answering questions at the end here when I unmute the lines through the webinar here. So please, any questions you have, write them down and we'll get to them at the end. All right, well, let's look at another scenario here that we've done a lot with, especially over the last year. And this concept has to do with loss recovery. I think it's an understatement to say that clients' investment portfolios are way down, and most of these clients are reliant on these portfolios to generate retirement income, either now or in the future. And a lot of these clients, they need to recover losses. Of course, they want to make their money back, but the main reason that they want to make the money back isn't just so they feel good, so they are not in the red here. It's because they need to generate income off of this portfolio, and they were in a situation where they were planning on taking a certain withdrawal amount off of this portfolio for retirement income, and now they've been told that, hey, we need for the market to come back before you can retire, before we can safely take this. And of course, in the back of their minds, they're thinking, hey, this may happen again, so I need to make sure I have guarantees for the future here when I go from the accumulation to the distribution stage. Let's look at an example here. I'm sure many of you have similar situations like this with your clients. A 65-year-old male that had $500,000 in their IRA. This guy planned on taking a 4% withdrawal because that's what his prudent financial planner told him based on past Monte Carlo scenarios. We could take a relatively safe 4% withdrawal off of that $500,000 a year from now, and you could generate 20 grand a year off of this portfolio, and that would have been fine for this client. That's what he needed off this IRA. But what happened? The client lost 25% of the value due to the market downturn. So now all of a sudden that $500,000 is $375,000. And now their financial planner, still being very prudent, is saying you can't safely take 20 grand per year off of this now. We either have to wait for that money to come back or you've got to take less. Well, the client still wants to retire a year from now. They still need that 20 grand, so he went looking for other options. Well, what we proposed is, of course, use a fixed indexed annuity with a guaranteed lifetime withdrawal benefit to recoup the market losses through a premium bonus, a guaranteed growth rate for 1 year, and then a guaranteed withdrawal rate. Here's how we did it. We used a Forethought Income 125, and we put $375,000 of the premium in there that was remaining. We gave him a 25% income account bonus plus a 5% first-year growth. So we gave them over a 30% boost to the client's income account year one. And like we said, income was the most important thing for this client after 1 year. At a 5% withdrawal rate, that generated, well, first of all, after that 30% boost, we got up to around 492 grand at your income account. And at a 5% withdrawal rate, that equals $24,000 per year of guaranteed annual income. Well, before the loss of the market here, the client said that when they had 500 grand, they could only safely take $20,000, and it wasn't guaranteed at a 4% withdrawal rate. Now, even after this market downturn where they lost 25% of their investment, we can move this, and in 1 year, you're telling me we can guarantee $24,000 per year, 4 grand more than I could before the loss? Of course, this made a lot of sense to the client, and income was most important to them. So they did this deal, and they were able to lock in that $24,000 of income 12 months from now, and the client could retire when they had planned on retiring. All right, well, let's look at one thing here, and I think I may actually be on time and get you guys done after 45 minutes here. So this is one of the newest things we have. It's really exciting with some of these new products that we have right now with this whole principal preservation idea. Now, I'm sure you have a lot of, I know I deal with a lot of agents that have older clients that are very conservative and that have always worked on, hey, I just want to draw interest only off of my CD or my fixed annuity, or I want to do a split annuity type of situation where I want to take money off of this, but I don't want to erode my principal. Well, shoot, we've got interest rates are so low on CDs and SPIAs and fixed annuities right now. I mean, a lot of these 5-year SPIAs right now, we can't even get back the money that we put in with a lot of these insurance companies because rates are so low. You can't blame the insurance companies. They just can't make any money on it. Some of them have eliminated even products shorter than 7 years and that type of thing. And, CDs, 1-year CDs paying less than 1%. And fixed annuities, the best 5-year we can find right now is just a little over 3%. So it's hard to pull a meaningful amount of income off of these products and preserve the principal. So, and a lot of clients, they still want guarantees. So what is the solution? Well, it's our insurance products here. We buy an annuity that has a death benefit guarantee rider. And we go on to go with one where we can take non-income rider withdrawals, just utilizing that 10% free withdrawal corridor during the surrender period. And that allows that death benefit to continue to grow on a guaranteed basis because of that rider while you're taking those withdrawals. So it's deducted from the client's account value, and it's deducted from the client's death benefit account. So you're able to achieve this interest-only style withdrawal, but at a higher level than, a current, 1, 2, 3, or 4% interest rate may allow you to do right now. Let me show you with an example. Here's one we just did. We had a 71-year-old male that had $636,000, and they wanted to take $27,500 income each year. This was as part of a different, bigger part of the income plan too. And they didn't want to deplete the principal. They wanted to be able to leave this money to the next generation. And they wanted to really target for the next 14 years or so, taking income through age 85. So we went round and round with some different ideas here, tried to use SPIAs, guaranteed lifetime withdrawal benefits, other things to try to put this into place. We even looked at buying life insurance to replace that $636,000, but at his older age, none of these numbers made sense until we looked at this Altasure Phoenix Life Annuity that has the gift rider that, as you remember, has the death benefit provision as well that grows 6% compounded annually. And you're allowed to take money out of this, not under the guaranteed lifetime withdrawal benefit, but just as a regular 10% withdrawal type of feature, and still have that death benefit growing. So, and we can illustrate this through their illustration software, that we can take out $30,000 annually from this annuity for the 14 years that the client wanted. I'm sorry, this is supposed to say $27,500. And at age 8, that money coming out of both sides of the account, the guaranteed death benefit account is still at $623,000. So they just lost basically 13 grand, 12, 13 grand off of that, but we're able to enjoy $30,000 for 14 years. So they were able to take out $420,000 out of that for 14 years and still not even really deplete their principal. And that's at age 85. And as another aside, too, the income account, too, is still growing at the 10% simple interest with the persistency bonuses. So at age 85, they could turn around and look, and they have almost $880 annual income if desired at that point. So you really get a lot of different options with this rider, and you can get creative with it. So if you have some type of principal preservation cases like this, or cases where death benefit is important, give us a call and we can help you figure out a way to solve it, possibly with this product and some others that we have that will do the same thing. All right, other options that we can use. Sometimes you need to do a life-only SPIA because that gives you the biggest payout when the client absolutely needs a certain amount of money. You can get a higher payout, but of course, less flexibility. Also, we don't want to forget about life insurance here. If you need a higher amount of money here, you need to maximize income off of that account but want to leave money for the next generation. Sometimes the best deal is to buy a life insurance policy that will pay out tax-free income to a spouse or to the next generation, and then just maximize income off of your assets now and let that life insurance be the income for the spouse or the next generation. So let's quickly recap here. What do we want to do? Most of all, let's sell income insurance. Stop saying these are pseudo-investment products here. Yeah, sure, there are some inventive strategies where we can get great returns in sideways markets, even in bull markets, and not have a risk of principal. But this income part differentiates you from other type of products that other advisors are selling out there. Contrast these type of strategies to non-guaranteed risky income strategies. Now we want to solve for essential and discretionary income now in the future, so you can show the client, hey, you're telling me you need 30 grand 5 years from now. If I can tell you I can guarantee you that amount of money by you giving me X amount of dollars, would you be interested? Also, we can use this as a loss recovery tool to help get money back due to stock market losses for the income account. Also, we can help preserve principal by utilizing some of these death benefit riders and even life insurance here in other cases. So I want to thank you for your time. Give us a buzz at 877-844-0900, or you can email us at info@ohlsongroup.com, and that is OHLSON group.com, and any of our marketing consultants can help you out here. All right, so let's see if I can get into this attendee list here and answer some questions.